All right, so we're going to rely heavily here on Excel. So there's a couple of ways. We're going to do questions 14 and 15. There's a couple ways you can do it. You can do the MPV function and use that formula, or you can type the numbers out. And I recommend you type the numbers out. So, and if it's initial cost, type it as a negative number. So net present value we're looking for, they invest money today in order to get these benefits. So here they're going to invest 19,000 today in order to get 8,000 next year, 9,000 in 2 years, and 7,000 in the third year. So your initial is negative 19,000, and then you put those other two. So yeah, the net present value problems should be really, really simple on this exam, as long as they let you use Excel. If they don't let you use Excel, then you'll do the same thing, but you have to figure out how to do it on a calculator. I'm still struggling to get my calculator to do what I want it to do. Well, there probably is an MPV function on your calculator, but if there's a present value function, I was trying to get the present value to work. The present value, though, assumes you have constant cash flows. So the NPV allows you to do different cash flows.
And also assumes that it's going to live.
Well, NPV assumes it's at the end of every year. Yeah, so it's annual. So what they're doing on this exam is not very realistic at all. All right, so if you type in the numbers, negative 19,000, then positive 8,000, then 9,000, then 7,000. In Excel, all you got to do is equal MPV, highlight all of those. Well, you put your discount rate in first, equal MPV, put the 11%, highlight all those, and let me know what you get when you do that.
And you should keep the project cost and so I
Yeah.
put it into the.
Well, so you're right. You actually don't put the project costs in there. You subtract it at the end. All right, so subtract the 19,000 from that. Yeah, okay, so that's one thing at NPV. It assumes whatever's in the first in your range happens 1 year from now, but that 19,000 hasn't happened today. So you do the NPV of the 8,000, 9,000, and 7,000, you subtract the 19,000. So what did you get? I think you got the right. All right, so B is the answer. But take note, for IRR, that's not the case. IRR, you have to have the negative number and the positives. So let's try the next one. It's the same problem. They just want to know the IRR. So here you're going to use the equal IRR. And IRR is easy. You just highlight all 4 cash flows and you got it. It's like the easiest formula of all. You like with that one? Oh, I thought it was higher than that, but. So you got the 19,000 as a negative number? Oh, I was looking at mine, I'm sorry. No, yeah, the order does matter. 19 has to go first. No, 19 has to go first.
Oh, it has to.
Yeah, your cost has to be the very first one. Yeah. So I was looking at my screen and going, no, that looks right, but well, that's my screen. I was don't see the problem. It's perfect.
I got the
13. All right. Now let's just test ourselves here because I think this is really critical. So I don't think you will ever do that in real life. So let's do real life. So what I want to see in real life is I'm going to do equal today. Yeah, and since net present value is assuming exactly 1 year from now, we're just going to go ahead and do that. Assume 1 year from now, 365. We'll have a leap year in there somewhere. So in the last one, use 366. So put those dates in there. So you just start with equal to date. That's a nice little function. And it doesn't just do the day, but it even shows the hours and the second and the minutes. So, and then you add 365, and then the last one add 366. And now we're going to use a different function. We're going to do equal X MPV, and let's see how close it is. So the rate is 11%. The values 19 through 7, and the dates, we should get something real close to that 6/30/15. It'd be a little bit off because 366 is a little, I don't know if we use 365, if it would give us the exact answer. Yeah, if you use 365 on the last year, you get 6/30/15. So the equal MPV function ignores leap years, obviously, because it doesn't know. So yeah, don't use 365 all the way down, and you should get exactly the same answer to 6/30/15. Were you able to get that to work? Yeah. Yeah, you can do that exact same thing with the IRR.
Oh, is it like
So
an
X, yeah, equal X IRR. And you just do the values and the dates, and it should give you the same answer you got before.
Yeah, I got it.
So, I mean, there's two ways to do it, so ignore the leap years. It makes sense that you have to ignore leap years because, Excel doesn't know. Everything's just 365 days. And so it's a way you can double check your answer, but the X NPV and XIR are far more powerful for you. Because like we said, it's unlikely these cash flows will be exactly a year apart. So it allows us to really control things a lot better. That way, if you have a tax payment, you know exactly what that date is, you can just put that date in, and then X MPV takes care of all of that. It's really a wonderful function. All right.
So if your discount rate changes from year to year, how do you calculate that? So let's say my cash flow was 8,000 in year 1 at 11% discount rate, and then in year 2 the 9,000 was at 8% discount.
Yeah, you'd have to do it manually.
Okay.
So it's unusual for discount rates to change. So the 19,000 is 19,000. The 8,000, you're going to use 11%. You just got to do 8,000 divided by 2 parentheses 1 plus 11%, raised to the first. Then you do the 9,000 divided by 2 parentheses 1 plus 0.08%, raised to the second. You'd have to do it manually. There's no other way. Your calculator can't do it. The calculator and these functions, they all assume the same rate every year. So if the 7,000 is say 6%, you raise that to the third, and then your net present value is just the sum of those. You just have to add them up. But yeah, there's no way to do it other than the MPV handles different cash flows, but it cannot handle different rates. So
it's 9,000 and then
divided by 2 parentheses 1 plus whatever rate you're using, and then you're in year 2, so you raise it to the second power, and then.
Divided by 1 plus the rate, and then.
Oh yeah, and I got a mistake right there. So 1 plus the rate, close parentheses, raised the third. Yeah, that last one I had wrong.
Raise the number of years.
Number of years.
Okay.
Now, if it's 2 years and 3 months, then you would just do 2.25. Another thing you can do, which I think is really pretty cool, if you got the dates in there, you don't have to raise it to the first. You can actually raise it to the date minus the beginning date and lock that beginning date in. And then when you do that, whoops, that should be 300. Oh, we have to I'm sorry, one last thing. That's 365 years. We don't want 365 years. We want year one, 365. And then when you do that, you don't have to keep changing. So there's 2 years and there's 3 years. So that's the nice thing about the date is, you know, it avoids you having to do all the numbers like that. But yeah, I mean, and that one actually got us the exact same answer, didn't it?
Yeah.
Because I copied it down with the same 11%. So yeah. I never knew about the NPV and XIRR, and I was sitting in on an Excel class, Investment Society, and I go, wait, what did you just do? I was like, I got all excited. I've started using it and everything because it's really, really powerful. All right, so what do we have left? So we'll try to finish up this week and next week. Some of these, they're just essay questions. I mean, they're just like a thought question. So one's on correlation. This one's really easy. If you're trying to diversify a portfolio, the best diversification is the lowest correlation. So if two things are highly correlated, they're not going to diversify. So if the correlation is 0.9, you can go highest you can go. So correlation ranges from, you'll learn this in your stats class. It goes from -1 to +1. So if two things are 0.99 correlated, putting them together, you're not going to get any diversification. But if two things are correlated, say 0.1 or -0.1, you put them together, a lot of your risk is going to disappear because they'll diversify. So that was a really easy question to ask you, which of the following is going to give you the best diversification. You just look for the lowest correlation, and even negative. So -0.2 is better than +0.1.
What is the correlation?
Correlation is it's a number you can actually just calculate. Let's see if I can find it. I have some spreadsheets that do that. Let's see. So here's a good example. So I've got Apple and Ford. So you can just use the correlation function, equal coral, and you just highlight Ford. Apple, you highlight Ford as long as they're lined up. Their correlation is 0.28. So it's correlated. The actual formula, you should learn it. It's actually not a very, very difficult formula. So correlation equals covariance. Oh, did it? Let me see. Maybe because I didn't switch. Boy, I don't know what screen I'm on. That's part of the problem here. Let's see. There it is. Is that it?
Yeah.
Okay, so you can do equal CORREL. I can highlight sum of Apple's stock returns and sum of Ford. You have to have the same level. If you go one extra period, it's going to give you an error message.
Okay.
So they have to be the exact same number of rows, but that will give you a correlation. A correlation is a formula you should know from memory. Very few students actually bother, but correlation is just covariance divided by the standard deviation of A times the standard deviation of B. In covariance, you're going to discover that there's 4 really, really important formulas in finance. There's standard deviation, there's correlation, there's R squared, and there's beta. Those are the most important one, and the formulas are almost identical. It's really, really amazing. So
That's what you guys do in spreadsheets, like the second sheet, it's the beta use R squared, and then the first.
yeah. So all 4 of these formulas, you start with, like for standard deviation, you get the average of all these numbers. And then standard deviation just takes each one of these numbers minus the average and then squares it. So if your average is 2%, they're going to take -0.0364 and subtract 2%. Then they'll take 488 and subtract 2%. And they square those. And so standard deviation is just the average of all those square differences, and you take the square root of that.
Okay, so it's standard deviation is the average of the R squared.
Not average of R squared, but averages of the differences squared.
Oh, okay.
Let me say, I'll actually calculate it. So the average for Apple was 0.55. So they made on average 0.55 a month. Right? So what standard deviation says is, I want to know, so I'm going to take That 364 minus the 0.55, I gotta lock it in. So that's a big difference. I'll copy that down. And standard deviation is just the average. Oh, and one last thing we do is we take that and we square it. And when you square it, all the negative numbers disappear. And so all standard deviation is, it's the average of those square differences. And you take the square root of it, and there's your standard deviation. Now there is a function that does that, equal STDEVP. I could have just done that. I'll get the exact same answer. But I encourage students to actually do this. So standard deviation, you take the difference of each month versus the average for all the months. You then square that. The standard deviation of average all those squares, that's standard deviation.
Okay, so the percentage minus the average squared.
Right. Then you got a bunch of those.
And then you take that and compare.
Take the average of all of those.
And that's your standard deviation.
Well, that's your volatility, and then the square root of that is your standard deviation.
Oh, okay, so it's just, okay, yeah, I can see it.
Yeah, it's a few steps. So the way I talk about it, it's take the difference.
And then you square.
In square, I say multiply, you'll see why.
And
Multiply.
then subtract from that average.
Well, take the average. So you get the difference, you square each of the differences, you take the average of all those square differences, and then you take the square root.
And then you do square root.
All right, now if you wanted to do correlation, correlation's the exact same thing, except here for Apple, we took the difference, but we're not going to square it for correlation. But what we are going to do, so there's Apple's average. We're also going to get the average for Ford. There's Ford's average.
Okay.
So guess what we do with Ford? The exact same thing. We're going to take each one of Ford's,
Subtract by the average.
just note, yeah, subtracted by the average, but we don't square it. For correlation, you don't square it, but you see my second step is either square or multiply. So square is you multiply by itself. For correlation, you don't multiply by itself. You multiply Apple's difference by Ford's difference. All right, a little bit. For standard deviation, we took this negative 420 and we squared it. For correlation, we need two columns. We had to have Apple and Ford. And so there's Apple's difference, there's Ford's difference. So we're just going to square those two. I mean, we're going to multiply those two together. And so we take all of those, and then we take the average of all of those, and that's called covariance.
And that's in the equation.
Yeah.
Covariance.
Yeah, that's the covariance. And so your correlation is your covariance divided by the standard deviation of Apple. We already have that, 5.8.
And then you start with the deviation.
Yeah, so the standard deviation of Ford, we can just calculate STEDVP. It's 5.6. So essentially, all we got to do is take this covariance and divide it by the standard deviation of Apple times the standard deviation of Ford, and there's their correlation. And that looks like what we got, right? Equals CORREL. You highlight Apple, comma, highlight Ford, and we should get the exact same answer. Now the easiest one's R squared. Guess what R squared is? Well, correlation is known as rho. So correlation is R, so R squared is just correlation squared. So that one's the easiest one of all. And then beta, you take covariance, but you don't divide by the standard deviation of the two. You have to have one of these has to be the stock market. So beta is the covariance of Apple versus the stock market divided by the standard deviation of market squared. That's the big difference in correlation. Correlation, you look into standard deviation of Apple and Ford. With beta, you have to have Apple in the stock market, but you only want stock market risk in there. So it's the covariance of Apple versus the market divided by the standard deviation of the market squared. But you see how these formulas are almost identical.
Or instructions, different resources that you got.
Yeah, I mean, you notice that every single one of them start with each month's return minus its average. All four of those functions start with that. And so when you take your stats class, they probably won't encourage you to memorize these formulas, but you should just know them. You really should. I encourage students to bring data in like this and actually calculate standard deviation, correlation, R squared, and beta by hand, and then check it with Excel's formulas. I think it's powerful. I know a lot of students that don't know the formulas, and so when they make a mistake, they don't know they made it. You know, you can plug it in the calculator and let the calculator do all the work, or let Bill Gates do all the work. But if you don't know what it's doing, you don't know when's, you know, you get a correlation of 1.2, you go, okay, is that right? Well, it can't be right because correlations can't be greater than 1. So I don't have the stock market in here, so I really can't do a beta. I can't do a beta between Apple and Ford because beta is always a stock versus a stock market. So I would have to have the stock market in here. So I can't actually do a beta.
So where do you get the market? So,
Well, Yahoo Finance, you can actually get the market from there. You just go to Yahoo Finance, click on the S&P 500 and ask for its monthly or weekly data. And they used to have it where you could download it. Now you have to highlight it and copy it and paste it into Excel. Yeah, but that's probably the easiest. You can get off of Bloomberg as well. Yeah, it's all over the place. But yeah, you're going to be using those four functions so much: standard deviation, correlation, R squared, and beta. You should. That's kind of like the anatomy of finance. You should just know it backwards and forwards. So when you have it in stats class, just really focus in on it. What am I measuring? What am I doing? I got to get this so I know these formulas by heart. Yeah, so what this is saying, and the best way to look at this is Ford and Apple, they're only correlated like 0.23. And what that means is, you look here, Apple was down 14%, but Ford was up 6%. So Ford really reduced your risk. And then you come down here, Apple's up 5%, but Ford's down 1.2%. So there, Apple really helps you. So what this means is, and you'll learn this theory, it's called CAPM, which is one of the next things on the exam. The capital asset pricing model says, hey, if you put Apple into a diversified portfolio, most of its risk is just going to disappear just because of diversification. Because sometimes Apple's up, sometimes it's down, but then sometimes Ford's up, sometimes it's down. And what the capital asset pricing model says is, a firm has two risks. Some of them are risks that are tied to the market and the economy. Some of them are specific just to Apple. And when you put a bunch of stocks together, that those risks that are specific just to the company, they all disappear because of diversification. And those risks, they're called unsystematic risks. Those risks account for about 70 to 80% of the risk of a stock. So when you add Apple into a portfolio with 20, 30 other stocks, 70, 80% of its risk is just going to disappear because they're going to be moving all over the place. And that's what correlation is telling you, is how much, in fact, this R squared is telling you between Ford and Apple, like 95% of their risk is going to disappear because they're going to offset each other. So that's kind of a nice thing. That's what the R squared is telling you. Yeah, I mean, if we graph these things, I mean, they're just going to be all over the place, right? It's just going to look like a bunch of random dots. They just don't move together. You know, they're just all over the place. You don't see a perfect straight line. There's some way over here where Apple's down 50% and, you know, Ford's up a bunch. That might have been a stock split that didn't get captured in my numbers. But yeah, that's what diversification means. So on the exam, they'll ask you, you got these four choices. You want to add one of these four choices to your portfolio, and you want the best diversification, and they'll just give you the correlations, and it's an easy question. You just take the lowest correlation. And the way I show it to students is, if you look at the standard deviation of Apple, Ford, Bank of America, all the way down, if I take the average of those average standard deviations is 30%. But if I put all those stocks together in a portfolio, the standard deviation portfolio is only 18%. So just by combining those 9 stocks together, I reduced my risk from 30% down to 18%. And all I did to reduce the risk was just put a bunch of stocks together. And that's called diversification. So your risk of your portfolio is not the average of the standard deviations of the stocks. because some stocks will be up, some will be down, they'll offset each other. So your risk is much lower. And that's the advantage of diversification. It's really, really a powerful thing. I have a blog on that if you ever want to read it. It's called, boy, what did I call it? I covered in my my risk management class. Let's see, Professor.
Your website or?
No, my
Oh, like the actual blog post, like what's it called?
yeah, Professor Sweet Musings. Here it is. It's called Diversification. Everyone does it, but does it actually work? So you'll have to be you'll be reading this for my risk management class. But yeah, diversification, everybody does it, but does it actually work? But just do Professor Sweet Musings and then find the one titled Diversification. And it talks about diversification from two standpoints. One is individual stocks in a portfolio, and the other one is asset classes, like US stocks, non-US stocks, bonds, those kind of things. So I talk both of those in there. And both of them use correlation. Huh? Musings, M-U-S-I-N-G-S. And everybody today says, oh, you got to diversify, you got to diversify. Well, that wasn't always believed. Back in before 1940, before we had computers, people said, no, you shouldn't diversify because then you got too many things to worry about. You should just buy a few things that you can really, really study. But that was before we had computers. You could get data off the internet. And so the world's changed. So now everybody says diversification, but if you read this article, you'll see diversification, it works except when you have a crisis, and then it doesn't work. So when you really, really need it, that's when it doesn't work. If, in 2008, if everything's falling together, the fact that you're diversified doesn't really help you. Everything's just crashing. But in normal times, yeah, normal times, some things are up, some things are down. Your portfolio is not very volatile. That's nice. But wouldn't you love to have nice diversification when the market's crashing? Have something up 30% when something's down 30%, but all stocks fall 30, 40%. Everything just falls together in a crisis. The only thing that was up significantly in 2008 was treasury bonds. If you've had treasuries, they were up 25, 30%, but no one has more than 1 or 2% in treasury bonds. If 98% of your portfolio is down 20, 30% and 1% is up 30%, it's not gonna help you all that much. So yeah. Well, you hope that you fell just like everybody else did, so your customers would have lost money with all your competitors, and you tell them, hey, everybody lost money, what are you going to do? Your goal is not to keep them from losing money. Your goal is to keep them from firing you and going somewhere else. It's the herd mentality. I don't agree with that approach. I use options. So, you got this distribution and the downside's really, really, really dangerous. I just like to cut the downside off with options and just not have to worry about it. Let me just take it completely off the table. Oh yeah, I love them. I love them. Well, they're dangerous if you don't know what you're doing, but they're also reduce risk significantly if you know what you're doing. So yeah. Well, but they're like buying insurance, right? So someone buys life insurance and they don't die, they shouldn't be upset. Right? They bought it just in case they die. So I'll buy options, 90% of the time, they'll just expire worthless, just like life insurance. But when they work, they're here. Like we did options in the investment portfolio back during the Tokyo earthquake. And when the market fell 11%, we were up 11%. So it really, really protected us a lot from that sell-off. So they're pretty powerful things. But you definitely want to read about them and understand how they work, because there's so many strategies out there. And there's a class we do have a options class at UTSA that you should try to take. They don't offer it every semester, so if you see it, you should jump on it. Yeah. Well, it's actually it's speculative markets, so it's options and futures and swaps. It's everything, but options would be a big chunk of it. Yeah. I mean, to me it's exciting because it's a really great asset class. it does some stuff you can't do with anything else.
The derivatives market one, right? That's what it's called now.
It may be derivatives. It used to be called speculative markets, but maybe it's derivatives
Yeah,
now.
it's the aspects of futures, options, other derivative investments.
Yeah, I mean, I cover swaps in the risk class, but yeah, derivatives are stock. There's only two derivatives. There are options and futures. Those are the only two. There's a bunch of like swaps. Swaps are a special type of future. A forward is a special type of future. A swaption is a special type of option. But in derivatives, there's only two types: options and futures, and then a bunch of kind of subcategories. And they're very, very different. So the class is probably going to spend half its time on options and half of its time on futures. And use that. In fact, my CFA exam, we had one whole book we had to read that just showed us that swaps and futures are mathematically the same thing. That was the whole book. Oh, the CFA, yeah, you definitely want to get the CFA if you want to be in the investment world. You don't have to worry about it now, but you could take part one your senior year, and that would really, really kick your resume off. Very few undergraduate students have part one, and part one's not, I mean, it's tough, but it's not nearly as hard as part two and three. And it only covers stuff you had undergraduates. I mean, except for you have to do the ethics and all that, but other than the ethics, everything on part one, you covered undergraduate. So it's not like new material. You'll still have to study a lot, but yeah, if you can take it in June and get it on your resume, boy, people would be begging you to come work for that question.
Yeah, I mean, like I'm planning to do it junior year, but right now I'm still trying to figure out like
I don't know if they'll let you do it your junior year. They might. They offer it December and June, but December is not good because it's right in the middle of finals.
yeah.
The June one's a whole month after finals, so it gives you a little bit of a break.
I'm going to do my senior year. That way.
Yeah, if you take it, even if, so when you're applying for jobs, you haven't taken it yet, but just put on your resume that you're sitting for the exam in June. That's going to impress people. So you don't even have to pass it. Just, have to be careful. The CFA is real strict on what you can say. So you can't say you're a CFA candidate. You just have to be. So their ethics rules tell you exactly what you can do on your resume. But once you put that on, that will generate buzz. Yeah, people. It's a tough exam, and they know students that are taking it are serious. So. All right, so that's correlation. We talked about systematic, unsystematic risk. Systematic risk is what beta is covering. Beta is measuring how much systematic risk you have. Unsystematic risk is that company-specific risk that disappears when you diversify your portfolio. So beta measures systematic risk. Standard deviation measures total risk. So standard deviation is measuring systematic and unsystematic risk. So, oh yeah, I'm sorry. I didn't want to do the normal way I do it because I got two screens and it's so confusing. All right. Someone changed the two screens and they're like backwards and it's real confusing right now. All right, so systematic risk, that's stuff you're exposed to the economy, interest rates, inflation. Unsystematic is specific to the company. It disappears when you diversify the portfolio. So beta measures systematic risk. Standard deviation measures the two of them combined, systematic and unsystematic. So if you say total risk is standard deviation, and you saw how to calculate that. All right, so we're getting close here. The CAPM formula, let me just give it to you. You can look at it and we'll maybe do some problems. The CAPM formula says the discount rate when valuing stocks equals a risk-free rate. That's usually the yield on a 10-year treasury, plus beta, which we just talked about, times what we call a market risk premium. Now on the FAC exam, you don't really have to know what the risk-free rate market risk premium is. All they do on the FAC exam, they ask 2 or 3 questions that just ask, can you manipulate that formula? It's a pretty easy formula, right?
Yeah.
Sometimes they might get you the discount rate, the beta and the market risk premium, and they want to know, can you figure out what the risk-free rate is? They might give you the return, and you got to figure out what the beta is. They might give you these 3 numbers, and you just calculate them out. Some questions, they give you this number, and they give you the beta, and they ask for the risk-free, and the answer is, I don't have enough information. So really, all of those questions, if you have this formula, you just see what they gave you, fill in what they gave you and look what you have left and figure that out. And if you don't have enough pieces, like if they didn't give you the risk-free rate and the market risk premium, they just gave you the discount rate and the beta, you don't know what the risk-free rate is because you don't know. So you can't figure it out if you have two missing pieces.
Do we have a trick question?
Yeah, on that one, but one of the multiple choice is not enough information. And so then you just say, okay, I don't have enough information. But these are, and not only that, but I remember when I took my CFA exam, this is a big chunk of the CFA exam. It's probably 10%, and I'm serious, it's just plugging numbers in this formula. When I took the CFA exam, the morning was all essay, and I felt pretty good about it. The afternoon is all multiple choice. I left the afternoon knowing I'd passed it because they kept asking these CAPM questions over and over again. And all I had to do is plug the three numbers in and give them the answer. It's so simple. So yeah, I don't know what they were trying to get from us other than can we do basic algebra. So I'll come up with some questions on these three, and then that just leaves us. Let me do this one because this one's real simple. They're going to ask the question, what's the goal of management? And you always just say their goal should be to maximize shareholder value. That one's a really easy one. So anytime you see that question, just say maximize shareholder value, and that's there. All right. So what we'll do next week, we'll finish up these last three. I'll give you some questions on this. And then I'll eventually, it may take me the winter break, but I'll eventually get an entire exam drafted up that I can send over to you so you can practice. I don't know when you'll take the fact. You may still be a year away or more. When do you take 3013?
I think 3013.
Yeah, so the fact is between that and your junior year.
No, I'm thinking of practice. So we'll see. I'm still waiting to hear back from Factor.
Okay.
So
yeah, so if you took it like in the fall of next year, then you might be able to take the fact, or between the fall and the spring. But it should be fairly easy for you now because we're covering everything on the exam. I only have 3 things left. A little bit of statistics. That's just one question. Just here, there's that standard deviation, right? You already know that formula, but your calculator in Excel, you just line up the numbers and you equal STD EVP, calculate it, and you've got it. So Excel does that for you. Arithmetic return is just equal average in Excel, and you highlight all the numbers and it gives you the average. So some of these questions are really, really simple. This confidence interval, we'll have to talk about that, but you'll see that in your stats class. And then a few ratios at the end that they cover, including ratios I don't think are any good. So they cover the quick ratio and the current ratio, and I think those are completely useless ratios. So we'll talk about those. All right, so we're doing well. I can tell you're understanding it, which is the most important thing. But it's good you're seeing this. I don't know when you take stats, but it's good that you're seeing this. When do you take stats? Sophomore. Yeah. So read this book and naked statistics. Read that this summer between semesters. It's a really good book, and it'll open your eyes to your stats class and how important it is. And hopefully you'll get a really good stats professor because it is actually one of the most important classes you. All right, so we're running out of semesters. So what I want to do today is let's just get some stuff out of the way. The minority interest was the one we're struggling with before. It's a really small number, so I really don't want to have to handle that. So I'm going to go down to that line 75 was the last thing we had to worry with, which is minority interest. So I'm just going to plug in a number 500 all the way across just to get it out of the way. Actually, I'm going to plug in 514. In fact, I'm just going to reference. That way we don't have to worry about the change in minority interest. If I did more work here, I might discover that they're getting 5% of revenue or something. But I actually think, that's the challenging thing here. I think this is actually not minority interest in Costco. I think it's Costco's minority interest in some of their fares. So, which means there's nothing we have here to tell us what that's going to be. If it was somebody else's minority interest at Costco, we could say, oh, it's 5% of their net income, but we don't even have that. So we'll just leave that out. All right, so down here we had net income minus dividends minus stock repurchases, and here they actually issue stock. I put the change in minority interest, but we'll see other changes. Change in net worth, beginning net worth. So we got this plug figure of the work. Yeah, remember that. It's kind of tedious, but we got that to work. So our ending net worth balance is all the way across here. All right, so we just got to do the exact same thing here. So why is our net income negative? What, do we have some issue here? We had something happen here, didn't we? I remember that was where we left it last time. So why are we getting zeros there? Does it have something to do with the cash flow statement? Cash flow AF 59. Yeah, so we just don't have. Yeah, it's just not, the numbers aren't in there. So where else can we get those numbers? So dividends, I don't know where we can get dividends. So, all right, so I'm gonna save this under a different name. Call it Costco forecast. And let's see, can I get into UTSA library fast enough to get capital IQ? Let's see. Find databases, capital IQ. Y'all remember how to do this? I never know if I remember my password. It's the IYG, isn't it? I mean, our ABC 1, 2, 3.
Yeah.
I never get it right though. There's some, I don't, if it's that or my email.
And you know, when it comes
The email, okay.
to, you need everything done,
All right, got in. All right, so let's go find Costco. Let's see if they have an updated schedule here. So income statement. Let's just download financials and let's just see. Coming in. So let's load it up and see if the cash flow statement looks any different. Ah, that looks a lot better, doesn't it? All right.
Not showing.
Oh, oh, because it's okay. Well, I have it, so I'm just gonna copy it over. Y'all have to just trust me. Okay. Oh man, I don't know where I copied from, but I'm just hit it there. Does that look right?
Looks good.
There's some problem down here. I don't know why. It's a different format. Cash flow. So why did they change their format? Okay, well, try it again. But this section right in here is a lot different, isn't it? Let's see where they made the change. Net income, depreciation, stock pay. Well, it's not even the same. It's sporadically different. All right, so there's capital expenditures there. Let's see if we can move this down. Maybe that'll line up. Is everything else lined up on the way down? Nope. Boy, all right, is there anybody know what's going wrong here? Did I bring in Costco? Yeah, it says Costco, cash flow. All right, let me try it again.
I think you can move it down another. Part of it will be the short-term debt and below will be.
We only need those few lines, right? So why don't we just find those few lines? So which lines are we using since we don't? So we need lines 59 and 63, 59 It's dividends paid, so 59 and then 63. Cash from financing. All right, where's cash from financing? So 15, so we need that one. We need cash from finances. So we need those two. So ours is going to be 58 and 62 and AN. Let's see if we can do that. Y'all remember these numbers because I won't remember. So we can go over to AN.
62.
All right, I think. Yeah, I wasn't expecting it to change so dramatically, but it. Let's see back over here. It looks like they changed their sign, doesn't it? So let's try it as a minus sign because it looks like they, for some reason, they made a big change here. And then stock repurchases is 55 and 56. 55, 56, issuance of stock. Looks like it's just this one line now, doesn't it? And it looks like they switched signs again. So minus AN 55. Minus AN 55. So the 55 is actually good. And then that one's probably okay. Add them all together. Changing net worth. Are we close? Beginning net worth. That looks right, doesn't it? We got it. All right, good. Okay, so sometimes you just gotta adjust. All right. So here's the scary part. We know our change in minority interest is gonna be 0. I think. We'll see how we. I think, isn't that just, yeah, that's just, I don't know why I did it like that, but this is just that minus that. So that minus 12, yeah, so that works. So we should be able to keep that going and we should just get all zeros. Y'all can see now why I did it at 514, just so it's all zeros. Other changes, let's see if that works. We'll have to put that in there. Then changing net worth, gaining net worth, net worth. All right, so this is going to be plus the prior year plus our change. Where is our change? Change in net worth. All right, so I got to figure out, we're going to get a circular formula here. Should work. The other changes, I think other changes, we're just going to make those 0. We'll see. I was thinking about this the other day. The other changes are 0. And we should have just been able to do common equity plus net income minus dividends minus stock repurchases. That's 0, so I don't really care about it. Let's see. That worked. All right, we're getting there. Does it look right? Looks pretty good, doesn't it?
Mm-hmm.
All right, the stock repurchases, who knows what that's going to be? I don't know what we did there, but the average is 6. You want to bring that up to 700 maybe? Let's see, but we're balanced. Y'all see how I got it to balance? So one way I got it to balance was just assume 0 and assume 0 here. We don't know what these other changes are, so it'd be nice to figure them out, but because we don't have a statement of owner's equity, right, I don't know what this capital structure summary is. There's just nothing that really tells us. It'd be nice, I always in class say I never use the statement of owner's equity, but here's a time where it would have been nice. And I just don't see it. So we don't know what those others are. Could be all kinds of things, but all right. So we've got a forecast, don't we? The balance sheet. And so let's do the cash flow statement. All right. So what we're going to do in the cash flow statement is I just want to over here get started because we'll have to do this next week. But so for the cash flow statement, remember what we got to do is we're trying to get this change right here. So
Are we gonna leave interest expense as nothing?
Oh, thanks. We have a few yellow items up here. All right, so let's get them up. Where's the interest? Okay, interest expense. All right. So we're going to do interest expense divided by total debt. What is our total debt? Total debt and leases. That may be a problem. So thanks, Bond. So there's our interest expense. So we got to make an assumption here. Their interest expense is awfully low. That may be just because they have some assets sitting there offsetting that, because this tends to be net. Let's just go with 1%. So we take the debt in the prior year. You remember that? We take the prior year's debt times your interest expense, right, or rate. It's going to be a huge number, but that's okay. Should have copied it over. Why is it not copying it over? Let's get that. Z60. Oh, because I have it. Where is Z60? Oh, total debt. All right. So take. I don't know if we can do this. We'll see. We may get a circular format. We didn't. Okay. Does that look reasonable? The debt. My graphs. Yeah. I mean, it's back off the COVID again, but it seems like a fairly constant. All right. What else did we forget, Bond? We have to just see. So the interest expense, actually, it looks really low when you look here, but if you look at that trajectory, it actually doesn't look all that far off. So it looks like COVID came around and, if you look at it, it doesn't look that bad, doesn't it? It looked really horrible when you looked at it just near term, but that, for an interest expense, doesn't that seem reasonable? Not all that wild. So, all right, what else are we missing? We got income taxes. I don't know why that's 24, other than we were going to come back and look at it again.
I think that's everything.
All right, so we should be good. Let's look at our net worth just to double check that I don't have anything. All right, would your boss say, "How in the world can you believe that?" Or does that seem reasonable? Right, so
Seems reasonable.
look that wild. All right, so for the cash flows, what we're trying to do for 2022 is we want to know why did cash go from 12,175 to 11,992, and we know it did it because everything else on the balance sheet changed. All right, so we have accounts receivable. Accounts receivable at 35. What are we going to do there? We're going to reduce net income as part of the net working capital requirement. So remember how the cash, how the cash flow statement works. You do net income and you do add and subtract non-cash items. So this is a non-cash item we're going to subtract from net income to get us the cash. Same thing here. We're going to reduce it, actually increase it. We're having our inventories are actually falling from 14 billion to 13 billion. So that's actually going to increase our net income. We're going to say reduce it by negative 473. Other current assets, we did that as percentage of assets. We're not sure what that is. I'm going to assume it's something related to accruals. So I'm going to do the same thing. I'm going to call it accruals because I'm not really sure it's related to net working capital, but we'll do that. Property, plant, and equipment. So here what we're going to do is, it came down. No, it went up. Okay, it went up. So we're going to put a portion as an outflow for cash for investing, but the depreciation added back to CFO. All right, so y'all know that, right? So you remember when we built this, I said, do I break out depreciation separately from this? And I didn't do it. But what we can do is we can add it in here without too much trouble. We'll just look and see what accumulated depreciation was. So let's just add in a line. Add another line just for information. So we'll do accumulated depreciation. This is solely for the building the cash flow statement. So let's go to the balance sheet and see if they give us accumulated depreciation. I think they did. You see that on line 33? And you remember what line you were starting in? 98. Okay. Oops. So J. All right. So and then we're going to look at that. This percentage of PP and E. Depreciation divided by that. 28%. Let's see how consistent that is over time. Oh, again, we got that issue with the current year. Why is that? Okay, I'm just gonna plug a number in. Okay, y'all just ignore me here. Come back and get that. I'll have to go find it. But for right now, we'll just plug in a number. All right. So what do we want to assume going forward? I'm just going to assume 50%. So that's pretty easy. Our property, plant, and equipment times 50%. So accumulated depreciation. So now we do have the change in accumulated depreciation. So the change in property, plant, and equipment plus, so this plus the change in accumulated depreciation goes to cash for investing. Everybody agree with that? And this we're going to add back to CFO. So we spent really $3.6 billion. So we're going to take $3.6 billion and take it out of investing, but our net income's down by 3.4 billion. Now, did we have depreciation in income statement? I don't think we did. It's just part of SG&A, right? So it's just in that number. So let me see what the chat is here.
Nothing important.
Okay. Any questions on that? So the 2399 is going to go on the investing, the 1391. I mean, the 2399 plus 1391 is going to go into investing cash flows, and the 1391 is going to go into CFO. All right. Other long-term assets, I'm going to put this in CF for investing. All right. I don't know exactly what it is, but it's not a huge number, so we're good there. So as long as we account for all of these and go in the right direction, we have to come back to the 183. All right. So let's do our liabilities. So we got accounts payable. What are we going to do that? It's going to go adjust CFO, right? just like we did for inventories and everything else. So it actually declines. So what's that going to do to our CFO? Is it going to increase it or decrease it? If accounts payable falls, you're going to actually decrease your CFO. Because that means you must have paid off some of those accounts payable. So that's actually going to reduce it. So let's think about that. Assets increase. That's going to reduce cash. Liabilities increase. What's that going to do? It's going to increase cash. All right. So if we see a positive numbers on the assets, we have to reduce our cash. You kind of think about it like here, you know, if you buy $2.4 billion or something, your cash goes down by 2 billion, your assets go up. And then you're going to do the exact opposite on the liabilities. So we're going to use that against, same thing here, really easy. That's just working capital. Unearned revenue, exact same thing again. These are easy. Other current liabilities, same thing. So the liabilities is a piece of cake. What about debt? That's an easy one, isn't it? Where are you going to put that?
From financing?
Financing. Yeah, Bond, you did the same thing I always do. I always say investing when I mean financing because I'm thinking investors, so it's pretty common. The tax liabilities, I'm going to put that in CFO because taxes go through CFO. Other non-current liabilities, I really don't know what that is. Non-current liabilities, what could that be? That could be pension plan. I think I'm gonna put that in CFO. I know we put the other assets on investing. Who knows? We'll see. One thing we can do, once we get this set up for 2022, we can actually go back and copy it for the actuals, and we can see if there's a line we're really off on. So, all right. And total liabilities, obviously, we have to do there. Common equity. All right. So common equity, we're actually going to do that. We actually have it right here. We've already built it. So net income is just, it's net income, right? It's the first line. So we've already got that one. That's a piece of cake. Dividends, that's going to come out cash for financing. Stock purchases, cash for financing. Change, that one's zero, so we don't have to worry about it. And then other changes, it's zero, so we don't have to worry about it. So it doesn't look that complicated, right? It just seems so easy when you set it up. Let's see if we can get it to work. So we're going to do a real simple one first, and then we're going to click it. CFO. So you have net income plus depreciation minus change in net working capital requirement. I'm actually probably going to put everything in net working capital requirement, even though I don't think it is. And so there's our CFO. We have cash for investing, cash for finance, and we have beginning cash, change in cash, ending cash. What's the probability you think we're going to get this right? So
40%.
40%, really? All right. I almost never get these right the first time. We'll see. All right. So let's just do one of them. Let's see. We got lines. These first three. The first three are all going into the working capital. So let's do that. So what do we want to do? So these, we said increase in assets reduces it. So we're going to subtract. Here, I'm not going to say minus. I'm just going to do change in net working. So we know if it's a minus sign, we know it's reducing cash flow. So we're going to subtract everything on the assets. So minus that, minus that, minus that, right? Anything else? And then we do the liabilities. We plus them, right? Plus that, plus that, plus that, plus that, plus that. Did I miss anything? Oh, plus that, hopefully I got them all. And then depreciation, how do we get depreciation? You take, we're adding that back, right? Did I get the right line? Yeah, so that we're gonna add back, that's really straightforward. It's the depreciation. My net income, where's my net income? I guess I can get that right there. So here's my CFO, we can just add them up. Cash for investing, we'll do minus that minus that. It looks like we did this one twice, but we didn't because we broke it out. So we're kind of just adjusting for it. And then for financing, we got minus dividends, minus stock repurchases. What else do we have? We had one other for investing, didn't we? We had the other assets. I don't think I'm in. So that declines, so that means we must have sold something. I have no idea, so we'll see. Beginning cash was 12,175, right? 12,175. Change in cash. Let's put the change in cash here. So we'll have it in 2 places. I kind of like doing this. I think it's always thought it was a lot of fun. So our change in cash is just really straightforward. We take the CFO plus investing. Oh, we know that's not right. So we got some problem somewhere. So our change in cash, beginning cash. So how far off are we? So actual ending cash. All right, what percentages, what probability did you say? Because it's, so we're off by 3180. I'm going to divide that by 2. Does that number ring a bell? 1590. So what did we do wrong? This is y'all's. So we here the financing. Oh, we left out the 482, so we need to do that. So what did that? So line 62. So financing. We want to. We said we add. Right. We add that number. So if debt declined, then we must have paid some debt off. So that's a cash outflow. All right. How far off we are now? 3661. 1830, that number sounds familiar to me. Got 1886. Did we get this number? I think we did. All right, but y'all see the process. I was thinking it wasn't going to work, and then I could spend the rest of the week fixing it. I can show y'all, but any ideas on what we're missing? We know we add that back. We know we subtracted the assets. Let's mark them. So someone write this down, 29, 32, 35. I got that? 29, 32, 35. All right, what comes next? Then plus 50, 53, 56. 53. 6, 959, 959, 9, 5, 9. I got all of them, right? So that looks good. Depreciation, we have that. We added that back. So that's good because we know. That should work because, okay, so for investing, since we added this back, we gotta get rid of it somewhere, subtract it. So we've got line 38 and 43. 38 43. Let me make sure I did that right. So that's the total amount, and this is actually gonna reduce it. That looks correct. I don't think there's an error in there. We bought 3.79, but we somehow sold 983, so 2808. That looks right. See a problem there. So we got that one.
Because they're on 40, we're supposed to add that back instead.
Yeah,
Subtract it in the formula.
on this one here. Well, we added back to CFO and then we subtracted
Okay,
here.
never mind. I was looking at it.
So it's essentially, that's just a wash, that 1391. We don't really know where it is in income because it's an SG&A, so we're just gonna pretend it's there, but then we get rid of it by subtracting it here. So it's essentially, okay, for financing. So we took dividends and stock repurchases. If we do that, we should be fine for getting the change in net worth, right? Because that's all the changes in net worth. So by doing those two, we've already got net income, it's our top line. We got those things. So let's just look at that. So our change in net worth is 19,303 minus that. So yeah, 1220. Yeah, that should be there. We got all those lines in there. So we've got that, we got that, we got that, we got that and that. So all of those are in there. So the last one we're missing is just that one. Let's make sure we added that. So our debt should have gone down, and it did. So that should be a negative cash flow. So we should be subtracting AH, whatever that was. Yeah, that should be reducing. It did. Changing cash. Maybe that's my problem if I misspelled cash. Changing cash is CFO plus that, plus that. Cash came down. All right, I'm not seeing it, so I'll have to work on this. That's our goal. Unless y'all have ideas on where to get it. We're off 1831. The other thing we can do is to equal sum all of these. Equal sum of these. That minus that. And then all we got left are the changes in net worth. Changes in net worth 12. Yeah, it's just too big of a number. I don't know what we're missing here. Okay. Think about it. If y'all want the spreadsheet so you can find it, let me know. I'll email it to you. But it usually, last year when we did this for Facebook, I think it took us 2 weeks to get it all work out. You know, it seems like it should work perfectly, right? You just don't see any major issue here. We'll have to change these formulas, obviously, not to go off over there on the side, but to actually reference the numbers. So let's make sure I've got everything here. Somehow pull the wrong line. I was just copying down, so that's Z minus Y is what we want. All right, I'll work on it. All right, that's it. So next week we should finish this up. This is probably all the detail we need. We can look at their cash flow statement, see how much more detail there is. So we don't need all that, right? We can combine those into things. Capital expenditures, we don't need all of that. So yeah, our level of detail is perfectly fine. So we're in good shape. So, all right. If you want the spreadsheet, email me and I'll send it over to you and you can see if y'all can figure it out. All right, guys, thanks.